Hi, good morning, everybody. This is Dan Sheridan, and I'm going to go over a trade in queues, and then I'm going to show you how I've automated the trade. So here's QQQ, and what's nice about it is it's much cheaper than trading in SPX, has good liquidity, but this would be called the double calendar. So I'm going to go over uh, a trade that we've talked about uh, in the morning show at Options Omega Live YouTube, and you can check it out just every morning at 8:45 Eastern. We'll go about a half hour. Troy, Matt, Rusty over at Options Omega, and I'm on there, and it's for teaching, uh, some humor, we think, and going over some trades, and Troy always will automate some trades. So this is one of the trades I have automated, but I just wanted to give you a little couple minutes on what is it. So this is a double calendar. If we just go through this, I'm doing a bullish calendar. So today is Tuesday. This trade will be automated tomorrow. So I'm just going maybe a day ahead of time. So I have this to automate it on Monday and automate the trade on Wednesday. And I'll go over the back testing in a second with you and the automation. But so this is Tuesday, June 24th. This will be activated tomorrow. So I'm just talking one day ahead of time. So this will be the trade. On Wednesday, I'll be selling the Friday expiration. I'll do a calendar with a 15 delta. So a bullish calendar, I'm going to sell tomorrow on Wednesday, sell the Friday, July 7th, June 27th, and I'm going to sell a 15 delta in the calls, and then just buy the same strike 5 points further out. So it's a bullish calendar. On Wednesday, it's really going to affect Monday and Wednesday, but particularly tomorrow, June 25th. On Wednesday, uh, it will sell, it's called a 2-7. It will sell the expiration 2 days out, which will be June 27th, and then buy an expiration 5 days further out, and it will be at a 15 delta for the short in the calls. And that will be you can see it here at the 547 strike. We're currently at Q's live around this 538.68, close to 539. On the downside, a little bit differently, we're going to do a 20 delta. We'll go, again, this is Tuesday today, but tomorrow, Wednesday, we'll go 2 days further out on Friday, sell a 20 delta put, the 531, and then just go 5 days further out and buy the same strike, 531. So you can see we have this tent between 531 and 537. And this is a kind of you can see the profitable area. This is at expiration. And this will be expiration of the shorts, June 27. The purple line is the graph today. So you look at this line and you say, okay, we have these big tents here. What about the middle? Well, does that make it a good or bad trade? Well, it looks like an owl. No, it just means I'm giving up some of the middle to get more room on the wings. So it's a positive theta trade, kind of an income trade, but I get more room. So you can see we're at 539. Our short call is 547. And our short put is 531. And incidentally, let me just bring up, if you look at the expected move through Friday, it's roughly 7 points. What does that mean? There's about a 68% probability one standard deviation from the current price will be up 7 or down 7 by expiration on the Friday. Well, our short strike is 8 points up from the current price. Our short put is 8 points down. So our shorts are more than the expected move. So do we have probabilities in our favor? Yes. And I'm going to show you what's great on the automation is at Options Omega. A lot of what I've been really burdened with for people over the years is risk management. Two great risk management techniques. One, you can see we're going to address, well, where do you lose money on this? And you kind of it can get problematic when we go too far past the short strikes. But also when the premium disappears, you can see in the middle here, if we don't do anything, it's a long Vega trade. If the premium in your short options disappears and your premium in your long starts going down, that could get problematic in the middle of the graph. So how do we deal with those two challenges? The price moving too far either way from the short strike in a double calendar, and the premium, because you're buying more premium in your longs than you're selling in your shorts. This is a range bound trade, positive theta, but you get a lot of room. So this would be a double calendar. It's a little bit long delta, which is fine. Your positive theta, it's a little bit long delta because as the market goes up, generally volatility can go down. So the price could benefit you. You gain a little bit from the long delta, but the volatility, as we go up, if volatility goes down, that could hurt us. I mean, the positive Vega here of 27 says if each of these volatility of each of these strikes goes down a point, you could lose $27. So this is the trade. This is what we're looking at, good probabilities. Now let's switch over. I want to switch over to Options Omega, and just now that we've talked about this double calendar that we're going on tomorrow, let's address a couple things here. First of all, these are my active trades that will be going on in Options Omega. Very easy, active. You can see here, new strategy. You've got these three dots here, how easy it is. This is the particular trade that we're going to be talking about today. And so the nice thing is, right now it's active, yes. Is it paused? No. If I hit these three dots, you can see here, I can deactivate the strategy. I can pause opening trade. So even though it's automated, you still could call off the attack, right? You could call it off if you would like to. Now, let's look at this back test and some of the powerful risk management at work here. So this brown thing, it's called a Monday, Wednesday, 2-7 double calendar and QQQ. It means we're looking to put it on Mondays and Wednesdays. And on Monday, we're looking to sell 2 days past Monday is Wednesday, and then buy an expiration 5 days further out. On Wednesday, we're looking to sell Friday and buy our longs 5 days further out. So if you look back test, if we click here, here's the back test, and I'll go through with you. And it's how easy, once you're comfortable with it, you can create automated strategy. It's just very user-friendly. So here's some of the things. You can see here, the test, it's been from 2022 to 2025. So there's a lot of occurrence, 258 trades. So that's a lot. It's not like 4 trades. 62% win percentage. So good win rate, which you would expect when you're doing a 20 delta in the puts, 15 deltas in the calls. Max drawdown, it's only like 5%, right? 5.5%. very good MAR ratio here. Starting capital 5,000, ending capital 83.56 in this particular back test. We'd open trades at 3:30 p.m. Eastern every Monday and Wednesday. So we deal with entry first, use exact days till expiration. It says allocate 100% of portfolio, but just up to one contract, which you'll see here. So up to one contract, which just means if we're looking at the trades, for a small account is perfect because I'm just doing, each one is going to be like 280 debit, 270 debit, 370. So it's a relatively small dollar amount for somebody to trade. Average length, days in trade, 1.8. I mean, it's a 2-day trade, right? You're selling your shorts on Monday, you're selling Wednesday. On Wednesday, you're selling Friday. And I like to open it up here. And then you see some exit. And we're going to open this up a little more. Exit, right? So we talked about entry. Exit trades at 3:30 p.m. Eastern, which would be about 2:30 on expiration, or on the day that your options expire. Or, and these are two powerful risk management techniques. Exit when the short-long ratio, that's just the premium of your shorts divided by the premium of your longs, that ratio is below 0.1. And that will, do you remember the graph there, folks? We had this, the graph of the calendar was like this. It kind of dipped, then you kind of had these wide wings that we were in. So we're concerned if it doesn't move and the premium of your shorts disappears, and then you have these longs that are going to have some volatility risk. And so you're concerned about that, and you're just concerned about a move too far past your shorts. Excuse the scribbly here. But and we talked about that previously, and I'm going to get into that a little more. You have some realistic miscellaneous slippage here. And QQQ is pretty liquid like SPY. Entry slippage 0.01, exit slippage 0.02, some blackout days, big moving days like Fed days out, and some opening fees so to make it realistic. But I want to go through this with you. So when you're setting it up, it is, relatively easy to set up a trade. You can see starting date, just going through this from the actual making the back test. You could see start date to end date, 5/20/25, 5/16/2022. So I just clicked SPX as far as SPX dailies were. So I've got, a lot of history. Ticker is Q. And then the way I set it up here for the double calendar, you can see here, sell put 20 delta, 2 days out, sell call 15 delta, 2 days out, and your longs are 7 days further out, and they're basically the same strike and everything, right? Use exact days to expiration. Starting funds $5,000, 100% margin allocation, but I'm just doing one contract, right? One contract. If we scroll down further, entry time, and this would be on Monday and Wednesdays, 3:30 Eastern. And you could see weekly frequency, Monday and Wednesday. And now I always like the risk management stuff. That's, I think, is the key to everything. Use early exit, 3:30 p.m., but use delta. And this is great. Watch this. As we said, once it goes through the short strikes and your short call or put goes in the money, right? On the put side, we sold a 20 delta. And so on the downside, when the, say, exit above leg delta of 70, when that delta of the short goes from 20 to 70, get out. On the upside, when the 15 delta call goes to, you put a minus 60 on the upside, exit below leg delta on the upside, 60. So when your deltas are getting near 60 on the upside, 70 uh, on the downside, you would exit. So that's very good risk management technique, because that's when you should be exiting a double calendar if it goes too far in the money. But the other powerful risk management technique is this exit when the short long ratio is below 0.1. And that's just saying when the premium disappears from your shorts, or the premium of your longs versus your shorts gets too low. So those are the two things that would bother me as a risk manager, right? Because the way you're setting this type of double calendar up with a 20 delta in the puts and 15 delta in the call, you're giving up that middle. So if volatility goes down or the premium disappears, that could be problematic. So with these two risk management tools, I think that's wonderful, and it does it for me, right? A couple other uh, uh, things as you get into uh, making it realistic at Options Omega, they would call it the Punisher. You have your slippage 0.01, exit slippage 0.02. Again, Q's is a pretty liquid vehicle. A dollar commissions. We have some blackout dates here, some Fed type days, and that's it. And if I like what I do at the testing, um, I can create automated strategy with it. So again, just want to go over that with you. A double calendar for short-term trade in Qs, and a little bit on the back testing. Hope that's a help to you. And I'm Dan Sheridan. It's Sheridan Risk Management. But you can catch me on Mondays through Fridays with the Options Omega team. If you go to Options Omega Live, YouTube at 8:45 Eastern for a half hour every day, grab your coffee and come and join us. Thanks.